My name is Steve Peterson. I'm the broker and owner of Infinity Investments. We're a commercial real estate and investment company. I started the company in November 2009. If you guys were in real estate, you can probably remember 2009. That was a very difficult time. I chose to leave the company I was working for at that time because I thought that there was opportunity. Man, I was a little bit crazy too.
We're just young. That's all. We did the same year. We were just young and dumb.
Right.
Enthusiastic.
It was the perfect time.
And it was the
focus
perfect
on
time.
Investing instead of
perfect time
brokering.
Because it was blood on the streets, and a lot of people had exited the market, and it was some really good deals out there. So I figured it was time to swing the bat. So I did set up the company, built a little bit of team. We moved here in this office in August 2012, purchased this unit and the two in the front. We got it for a pretty good deal. And so it was important to us to have an ownership stake in Oakland, in downtown Oakland. I didn't just want to lease my office, I wanted to own. And I thought that was important because, kind of our philosophy is to, develop cash flow, build wealth. So I didn't want to be teaching and selling investments to people, but I still, renting the office. So that's why we took the risk in buying this place. We built it out, and we did that so that we can kind of have a base and have a headquarters in Oakland. So that's a little bit about the company. Our focus is apartment buildings, multifamily property. Now, we do other asset classes of real estate, but the focus, the bread and butter, the sweet spot is multifamily property. I just think, and I'll go into why I think that's the best asset class to invest in. Obviously, it's not the only thing I do. This is retail property right here. So obviously, we invested in that. Also, single family homes. But multifamily is our specialty, and not just the sale of it. Obviously, as brokers, we sell property, but we acquire property, syndicate, put other investors together, to acquire property. And manage buildings as well. But it's all really about apartment buildings. Now, let's talk about the different food groups of real estate. Most people think about real estate, they think about a single family house, right? That's the majority of properties out there are residential properties. But that's just one category. Even within residential, you've got condos, townhouses, you've got 2 to 4 unit residential income. So that's within residential properties, there's more than just single family homes to invest in. Once you go 5+ units, so you got a 5-unit building, it's an apartment building, people are living there, so it's their residence. However, you have commercial real estate, and this is why. Because you can't go to the bank and get a residential loan, right? Still residential in a sense because people live there, but now you're in the world of commercial real estate. So you gotta go get a commercial loan, which is totally different than a residential loan. Two different underwriting processes, and also, the regulations are different. When you're dealing 1 to 4, you're dealing with consumers. And even if you're not dealing with consumers, you're considered as a consumer if you're buying something like that. It's a hard money loan. If it's a regular bank loan, that's a consumer loan. Once you go 5 units, it's a commercial loan. Everyone, whether you're sophisticated or not, you're considered to be when you're buying commercial real estate. So it's just a different level, and it's a different type of loan. More so, the loan is underwritten off the income of the property than the income of the borrower. The income of the borrower still matters, right? The income, the assets, all of that, but they're looking primarily at the income of the units. What is the property bringing in? And that's what lenders are going to underwrite. That's key to understand, because a lot of investors looking to make that shift. You just need to understand that and be ready for that. It's not the same. It's a little bit different. Okay, within commercial, you got a lot of different product types within commercial. Retail, like the place we're in now, office buildings like the high rises you see, industrial warehouses, R&D, research and development, hospitality, hotels, motels, so on and so forth. And then there's even more food groups we can go into. These are the top ones, all right? At the end of the day, there's no one that's absolutely better than the other. I just think it's a matter of preference. I know people who do hospitality, who do office and retail, make a lot of money. I know people who do single family homes, flips, and rentals that make a lot of money. I just think it has to do with your personal preference, what you like. That's important, right? What you're familiar with, what you feel comfortable with. I think you will have the best chance for success in dealing with properties that interest you the most and that you have a comfortability level with. Doesn't mean you can't do others, but I just think there's so many things to do, you're better off focusing. So we focus on multifamily. Why we focus on multifamily? Well, there's a few reasons. Number one, stable cash flow during the hold period. All right, when we talk about hold period, that's the estimated time that you're going to hold the property. All right, when you buy investment property, you should have the goal of owning it for a little while. In fact, if you buy it with the intention to flip, right? With the intent, you buy it, you fix it up and sell it, that's your intention, then you don't have investment property, you have what's called dealer property. And you're not an investor, at least on that property, you're a trader, you're a dealer. What that means is this, is that the IRS looks at that deal, at that property, as inventory, like a business that is selling things. It's treated as ordinary income, right? It's not treated as an investment. The difference between a flip property and investment is that the purpose of that property, your intention is to own it for the rental income, right? And or if you're an owner user, like me, I own the business and we use this space for our business, then you're using it for business purposes. Now that's an investment, right? When you trade in property, that's that's a trade property. It's a dealer property. You're just going to be taxed differently. Just understand that. You cannot do a 1031 exchange on a flip. You got to pay that tax. Now, if you do one, you get caught. It's not good, right? It's not good. So you're not supposed to do that. You can do a 1031 exchange, which is when you sell, you defer the taxes, right? If you're doing investment property, okay? So I wanted to make that point right there. And that relates to the stable cash flow during the hold period. The hold period being the time you intend to own it, right? It could be 2 years, it could be 3 years, it could be whenever you own it indefinitely. Mr. Williams, you own property since the 70s, and it's paid off and it's generating income, right? So the bottom line is, through the ups and downs of the economy, and we've seen this recently, all right, 2008, 2009, even at the worst of times, multifamily occupancy rates outperformed all the other asset classes. Retail, office, especially retail, office, hospitality. And check this out, even single family houses. Because here's the deal. With the single family house, if you got it rented out, right, you're 100% occupied. What happens when it's vacant? 100% vacant, right? So in a bad economy, right, when it's hard to find tenants, that's a challenge. That's a challenge. You don't have what we call economies of scale. I say economies of scale that single family homes don't have. Well, you got 10 units, 3 people move out. You still got 7 people, bringing income in, okay? Now you got to go collect on them. That's another thing. But, in theory, they're going to be paying you rent. So you can weather the storm, right? You can get through, the difficult spots, the difficult times, because you have a couple different units that are bringing you income in, all right? Also, I just got to say this. It's a great way to do 2 things. To preserve wealth. So if you have a lot of money, right, and you're trying to figure out where do I stick it? I got some money over here, like Jason Matthews was talking about the 4 buckets. Got some money in my stocks, my life insurance, maybe got a structured sale, but you can sit on some more money, right? You don't want it just to sit in the bank, because your bank, you're earning whatever, less than 1%. If you buy property in downtown San Francisco, right? You guys are in the San Francisco market. Your cap rate, and I'll talk about what that is, the yield you get, it's not going to be that high, right? The cash flow is not going to be that outrageous. The reason you buy in a market like that is because you're looking for a place to put your money, preserve that wealth, and you have a really good expectation that that property is going to grow in value because you're in downtown San Francisco, right? It's a great place to put your money to preserve your wealth, even when there's a downturn, right? Because you got income coming in that should be able to cash flow, right? And protect your investment that you put into the property. So it's a great preserver of wealth. It's also a great generator of wealth. You ain't got no money. You broke. You're trying to get there, right? You put a couple dollars together, you buy a 4-plex, it does well, you trade up, now you're in the 10 unit. A couple of my clients sold a couple single family home investments, just purchased a 50 unit plus apartment building in Stockton, right? Off a single family home, right? They were able to roll that up, and now that's generating wealth, right? So it does both. That's why I like apartments. If you're rich and you got money, it's a good place to stick it. If you're poor, you ain't got no money, it's a good place to, you know, to get, to build up, right? And with minimizing your risk. Because when we get in, like when I bought this place here, I took a little bit of risk. It took me 7 months to find a tenant. When we get a vacancy in one of our apartments, it's less than a week or two before we find a tenant. You understand? So that's just part of how multifamily properties help you to hedge the risk, help you to balance out the portfolio, preserve wealth, and also generate wealth. Key point before I move on is when the market drops, prices probably crash 50-60%, maybe more than that. Rents never really drop more than about 10-15%. In our market, I'm talking about Oakland, East Bay area. I'm talking about middle of the country somewhere, but here, the prices crashed. The rents, they just came down a little bit, right? Vacancy rate grew a little bit, but it didn't crash 50-60%. Because why? But for the most of us, we don't do what it takes. Especially if you got kids, right? You got kids, you're going to do what it takes to have a roof over your head, right? So that's why multifamily properties are, in my opinion, the best asset class and why I focus on it. Doesn't mean it's you know the only one you should do or whatever. But that's why I set this company up to focus on that. We're in the Bay Area, so this is probably I don't know in terms of the wealth.
Highest wealth in the area.
But it's a lot of money around here.
Highest wealth in the United States of America.
Right? So it's competitive, right? Therefore, you don't want to just go crazy, you know what I mean, and you don't get out of control going out and just buying whatever. You gotta have some criteria. You gotta have a method, methodology, a philosophy of what you're doing. You don't just throw mud on the wall. So here's some key points that we look at as investors and brokers to qualify a property, make sure it makes sense for us. The cash flow, number one, right? NOI detail, that stands for net operating income and the details around that. The price and the relationship to the cap rate. Cap rate means capitalization rate. I'm going to go into that a little bit later and break that down. The rent roll. The rent roll is the list of tenants that are occupying the property, the list of vacant units and the potential market rent. That's critical. And then here's a big number. It's called cash on cash return. Matthews had a good point. He said, was it cash is king?
Cash is always king.
Absolutely. Now, how do you measure whether the cash you have is generating enough money or not generating enough money? Whether that cash you have is producing enough. The way you measure that is called cash on cash return. There's other things, but the cash you receive from the cash you invested annually basically is the cash on cash return. That's an important number. So these are the few matrices that we looking at in order to evaluate a property to see, hey, is this going to make sense for our investment portfolio and or is this going to make sense for our investors' portfolio, right? Okay, so when you're looking at a property, and here, this is for some of you guys who've been around the business, this is going to be ABC stuff. For some of y'all looking into getting in this, pay real good attention because this is what the lifeblood of the business is all about. We got to do an evaluation of income, right? We start what we call the gross schedule rents. The gross schedule rents is the gross schedule rents is the most rent that you could bring in. Look at it this way. If every unit in the building is leased out 12 months a year, that's the gross schedule rent. The highest amount of rent you could possibly bring in. You ain't gonna bring in any more than this because you're only renting units at X amount, right? X amount times 12, however many units you got. That's the gross schedule rent. That's how much if everything was rented out, if everybody paid their rent, that's how much you would bring in. Look at it like this. It's a 4-unit, and the rents are $1,000 a month, right? That's $4,000 a month times 12, $48,000 a year. Yeah, $48,000 a year. So that's your gross schedule rent. Now you take that number and you start knocking stuff off of it. The first thing you're going to look at is your vacancy, the vacancy rate, right? Two things. You want to look at the vacancy rate of the building that you're looking at or you're evaluating, and then the vacancy rate of the market. All right. Every city is going to have a different vacancy rate. Every neighborhood within a city is going to have a different vacancy rate, right? For instance, East Oakland is going to have a little bit different vacancy rate than Lake Marion. Although East Oakland is about 3% right now, 3% vacancy rate. Lake Marion, there may not be any vacancy. You know what I mean? But just say it like this, it's a little bit different from city to city, state to state, and it's also within a city from neighborhood to neighborhood, right? But you gotta know the vacancy rate of the building, vacancy rate of the market. After that, we take off, subtract loss to lease and or concessions. So this is your concessions, meaning if you have to do a first month free or the half off the deposit to get somebody in, something like that. Rental turnover, people moving in, people moving out. Also something that you gotta account for, which is difficult, but you just gotta account for it, is people not paying their rent. All right? So that happens. Now, after you've taken away from that, you gotta add. Now you add what we call other income. And that usually is laundry and vending. Now, these are gonna be on bigger properties, 30 units, 40 units, something like that. You're not gonna typically have a vending machine at a fourplex, but you might have a laundry room, right? So that's other income. You see, when you walk outside, there's a big billboard on this building right here. They're getting paid a handsome check every month. They're having that billboard on their building. So other income. And if you don't have any other income, try to find it, if you can, right? So you take a Comcast, right, on a big building. I think it's over 40 units. Comcast will pay you as a landlord for everybody that signs up through their service, something like that. But it's just a way, exactly, to generate additional income on top of the rents, right? So you got the gross schedule rents, you take away vacancy, loss of lease, you add other income, and that gets you your effective, it is, gross income. This is the money you make before you start paying some bills, right? All right? On that note, now this is where the rubber meets the road, all right? Operating expenses. Now, check it out. I say operating expenses. This is the expenses before your mortgage, right? You know you got mortgage. Now, here's the biggest mistake I've seen from 2004 to 2007. People forgot all about this right here. I had a lot of people that was looking at buildings, and when I look at a building, I run an APOD, that's a pro forma, annual property operating data sheet. That's my numbers, my projections. And so I look, hey, here's the income, here's the bill. People, taxes, insurance, maintenance? Oh, I'm just gonna pay my mortgage, as long as it pays the mortgage. But what about all this other stuff, right? This is the the cost of operation. This is what it's gonna cost you to run this building. This is the acronym. These are most famous. These are the more consistent expenses. There's others, but these are the ones you're probably definitely gonna see. Taxes, right? Now here it is. Two forms of taxes. Property tax, right? But a lot of people forget, hey, if you got a property, it's making you money, you got money in your pocket, income tax. You got to pay income tax. It's okay, you made money. But just understand that if you're making money off the property, there's some write-offs that come along with it. But if you make good cash flow, you might have to pay taxes on that. So just understand that, be ready. That shocks a lot of investors. And they say, hey, I had a good year. Oh, wait a minute, I got to raise taxes? Yeah, taxes. Plan on it. After that, you got insurance, property insurance. Sometimes on a big property, you may have general liability insurance, which I truly advise you to get, especially once you start getting 5 units and above. Management, you got to have somebody to manage your property. And you can manage your property individually, right? But what was it, toilets and tenants and, termites, all that? Well, you can hire somebody like a broker like me or, another company, a professional to come in and manage now, they're not going to do it for free, right? So you got to pay them. 2 things. If it's a bigger building, you have to have an on-site. Anything in the state of California, 16 units and above, you have to have an on-site resident manager. Why? Because of a fire or something like that, people's lives are in danger. Somebody has to be accountable and be there to act on the spot. So in the state of California, 16 units and above, you must have an on-site manager, and you're probably going to have an off-site company to pay as well. Just budget it in. Maintenance. Somebody moves out, you got to fix the unit up. So somebody, toilet bust, you got to fix that. Now, here's the big deal. You don't got to fix it necessarily. Right? So I've never done no toilets. I'm not good on no toilets. Right? If I got a toilet that busts, I got a maintenance guy. I'm going to call a maintenance guy. He's going to come do the toilet. Right? I got people to go and fix stuff. Right? But it costs money. So you got to budget for it. Utilities, gas, electric, water. These are things you got to pay. And it's good if a building is individually metered. How many of y'all know what that is? Yeah. That's when the tenant pays their own PG&E. And if you find a building where the tenant pay their own water, right? You're really doing good at that point. That cuts down costs. And that's the thing. You got one of them buildings with a tenant's paying the water, that expense is off your back.
Thank you.
So with that, now I'm gonna kind of blast. We got 15 minutes left. So repairs, which we say different from maintenance, because hey, if you need to make a capital improvement, you need to fix a water heater, something like that. That's a repair. Reserves. You need to have reserves for a bill that pop up like Mr. Williams was just talking about. So stack some money away. If it's $100 a month, whatever it is, stack it away because you need to have reserves. That's operating expenses. There's other ones, but those are the main ones. You need to account for them, you need to budget for them. Now, that brings us to this critical number. It's called net operating income. You take your gross effective income, the effective rental income, minus the total operating expenses, right? That's gonna get you the net operating income, right? Anything that's 5+ units, this is the value of the property, right? The appraiser, they're looking at your property, they're gonna take this, they're gonna divide it by what's called a capitalization rate, they're gonna come up with a value of the property. This is critical because this is the money that you use to pay your mortgage and pay yourself. And you have to pay yourself. This idea of if a property just pays for itself is risky, because if that month where it don't pay for itself, then you got to pay for it, right? So it should be paying you, and if you're paying the mortgage and paying you, even if it's just a little bit, but make sure it pays you, right? So, it's basically, the way I broke it down is what's left over after you collect the rents, pay your bills, but before you pay your mortgage. It's critical, right? Now, the reason why it's really, really critical, especially when you get to 5 units and above, is because something called a capitalization rate, all right? I'm gonna try to break this down as quickly as I can, but this is an important measure to know. 1 to 4 units, not so much, but 5+ units is everything. The capitalization rate essentially is the rate of return generated by a real estate investment property based on the annual year, net operating income that a property generates, right? So the rate of return generated by a real estate investment property based on the annual net operating income that a property generates, all right? Basically, it represents the percentage return, the percent return you would get from a building if you paid cash and did not have a mortgage, all right? So let's just say mortgage out the window, right? You pay, it's $1 million property, right? Say it's 10 units, $1 million, right? You got the $1 million, paid it off, no mortgage, right? If that net operating income, what's left over after you pay the bills, is $100,000. That's the money you would put in there's no mortgage, right? You put that in your pocket. Now, you could have some taxes, but that's the money you put in your pocket. So that's your return, right? That's the yield, the return. That $100,000. You bought it for $1 million. Got that $100,000 after you paid all the bills. That's your net operating income. That is let me ask y'all, what's 100,000 on $1 million?
10%.
10%. That's a 10% cap rate. 10% capitalization rate. Basically, the formula looks like this: net operating income divided by the purchase price equals your cap rate. So if I took that 100,000 divided by $1 million, right, I get 10%, 0.1, 10%. 10% rate of return on my money, right? That's a critical measure. It's going to help you to understand whether this deal is a good deal or a bad deal. It's going to help you to understand whether you can pay your mortgage, you not pay your mortgage, and it's going to directly correlate to the value of the property. 5+ units, when an appraiser comes to your property, they're looking at the cap rate more so than they're looking at the sales comps. They're going to run sales comps, right? See what stuff sold for, that's important. But the first look at the measure of value is the capitalization rate. And this is the same example I just said, but then you can kind of see it. 10% cap rate equals 100,000 divided by $1 million purchase price. Now, cap rate, this is the key to understand. Cap rates, just like vacancy rates, are going to shift based on city, based on market, right? Based on economic conditions. Let's say you bought this building at a 10% cap rate, right? Had the cash, paid it, generated $100,000 a year. 5 years later, the market is improved. And let's just say the market cap rate is 5%. And it's happened to people. This has happened a lot, especially when the market really shoots up. So let's just say this, y'all. Say you took that $100,000, and by the way, this formula is an inversely related formula. you can switch the numbers around to get to get to the other number. So if I have 2 out of the 3, I can always find the other number. All right. Perfect example. If I got $100,000 NOI, right? If I divide that, I'm trying to see what is the place worth. I've owned it for 5 years, right? So I bought it for $1 million, owned it for 5 years. It's still netting $100,000 a year, but the market's improved. So I want to see how much. Well, if I'm going to sell it, how much can I sell it for? I look in the reports. I say, oh, market cap rates are 5%. So this is how you determine the value. You take $100,000, divide it instead of by 10%. You divide it by 5%. That's how you can get the purchase price. Inverse relationship, right? So if you take 100,000 and divide it by 5%, 0.05, right here, what's that number?
$2 million.
$2 million, right? It's $1 million profit, right? That's why the cap rate is real important. It's important for you to, and cap rates are generally, related to interest rates. They affect each other, but it's important to know what the market cap rate is going in. It's important to know what the cap rate is throughout the whole period, and it's real important to know what the cap rate is when it's time to sell. That makes sense? Rule of thumb, real simple. It's just the opposite of stocks. The higher, the better when you buy. You want to buy at a 10 cap, and you want to sell at a 5 cap. The lower, the better when you sell, right? Because of the relationship to the value. Higher, the better when you buy. Lower, the better when you sell. Just remember that. And that's what. So we were looking at properties that are a higher cap rate. Even in San Francisco, if the market's 3, you want to try to buy at 3.5, right? You want to always stay ahead of the market. It's simple stuff. All right. Now, a couple quick other terms. I'm not going to break them down, but important. Net cash flow is the money left over after you pay the mortgage. You got your net operating income, right? You pay your mortgage. Net cash flow, right? And if it's a positive number, you may have to pay some tax on it. So keep that in mind. This is important. Cash on cash return. This is the measure of return. This is going to say, hey, you got cash flow, but is this cash flow good enough, right? It's always got to be a standard. Is it good enough? Hey, you made it to the playoffs, but did you make it to the Super Bowl? Sorry, Niner fans. I had to throw that in. But it's a measure, okay? And this is how you come up with that number. You take the down payment plus your closing costs, right? How many know we got closing costs in addition to our down payment? Those are typically mortgage fees. Your down payment plus your closing costs, right? That's your cash invested, right? Well, how you're going to get there is you're going to take the net cash flow, the money you make every year after you pay your mortgage, divide that by the down payment and closing costs, and that's going to get you a percentage, right? A general rule of thumb, you can't use this in San Francisco, but a general rule of thumb, I like to see properties generate at least a 10% cash on cash return. As the market gets tight, that's harder to achieve, but you want to at least get 10% of your money in general. Now, hey, we're in the Bay Area. When I first started in real estate in 2003, that was hard to find in the Bay Area. So I started doing deals out of the state, right? Now you actually can find that here in Oakland and other parts of the Bay. Probably not San Francisco unless you got an inside track, but every market's different, every investor is different. You got to figure out what your minimum cash on cash return is going to be to whether you can evaluate whether this is a good deal or a bad deal. Also, lastly, internal rate of return. I'm not going to go into this. It's a little bit more technical. Institutions more look at this. But basically, it's the total rate of return on the initial investment on an annual basis once the property is sold or over the holding period. So an internal rate of return looks at the cash flow, looks at the mortgage pay down every year. You should be paying the mortgage down a little bit, whether the property goes up or down in value, and then the tax benefit. Internal rate of return looks at everything. So you also want to have an idea of what the appreciation is in the market, the cap rate is in the market, not just the cash flow. You lead with the cash flow and then look at other things. So these are the cash flow, cash on cash return, IRR, also, which is called internal rate of return, IRR, if you hear somebody say that. These are the key measures that are going to dictate whether a deal is good or bad. Make sense? All right, I'm blasting through it because we just got a few more minutes. Okay, a couple strategies, and this is more, there's a million strategies and techniques and stuff like that. I'm going to cover 2 main ways of buying real estate. First way is buying on your own, right? So, but then the other one I'm going to talk about is buying with the group or buying with others, right? When you buy, there's a million different strategies and techniques you can go into, right? This page can't hold them all. I put up here a long time ago, REOs, short sales, distress sales. REOs are disappearing. They're almost gone now. They're not, but real estate owned by the bank is what REO means. There's not a lot of them anymore. Short sales, there's not a lot of them anymore. I mean, they're out there, but not like it was a few years ago. Distressed property. This is something. Distressed property, obviously a short sale on REO is distressed, but also something that needs a lot of work, something that might be going through bankruptcy, divorce, you name it, whatever distress, probate, right? There's some sort of distress, so the property should be sold at a discount. You want to look for these type of things. Here's another thing, note acquisition, okay? It's called the loan to own strategy. Basically, you can buy a loan as an investor from a bank or a lender at a discount, of course, and then you become a lender. And at that point, you can make progress towards taking the property back via foreclosure or whatever, other ways, deed in lieu, so on and so forth. Or you can just, if you bought the loan at a cheap enough price, you can get the income from the property, right? Say you bought a loan that was a $100,000 loan. You bought it for $50,000, but the rate's 10% on $100,000. So now that income coming into you is pretty attractive. Or somebody's about to go into foreclosure, the lender wants to sell a loan just to get off, you buy it at a discount and you finish off the foreclosure, you buy the property. It's basically the best way you can buy a property at a discount. Understand though, it's a little bit risky. You become a lender, so you need to know the laws, you need to have an attorney, all that. But it's a good strategy. Also, wholesaling, when you buy it, you get a contract together. There's a couple wholesalers I know here, Deb, I know you do a lot of wholesaling. You get a property under contract, and then you sell the contract in essence to another investor who's going to get it and then flip it. And then you make a fee for doing that. That's called wholesaling. Buying and holding for cash flow, not necessarily a strategy more than it is for a plan. That's just buying rental property for the purpose of achieving the income, right? Buying and flipping. And we talked about that at first. That's when you buy something for the purpose of the resale, the profit, not for the income. Also another good way of making money, you just need to know what you're doing. Buy, hold, and exchange. This is a little bit different. Or buy, hold, and structure sale. But buy, hold, and when you sell, you ain't paying the taxes. You would roll it up to another property or do a structured sale to where you're not paying the capital gains on that sale. You're deferring it, right? When you buy and flip, you're paying that. And you're going to pay ordinary income tax, but you're paying tax. So buy, hold, and exchange or structured sale is a way for you to preserve the wealth because like Matthew say, the biggest killer of wealth is taxes. Probably the biggest, I have to argue with that, probably the biggest killer of wealth is procrastination.
Yes, it is. Yes, it is.
And not taking advantage of opportunities. That's why it's important that y'all here tonight. Whether you take a point from tonight or not, you are investing your time into educating yourself to do something. And so while taxes do kill our wealth though. So, but just understand that when you exchange up, you defer the wealth. You defer the taxes. And it's a good strategy. Also, contract for deed, lease option, seller financing, joint venture. These are creative financing techniques for you to be able to acquire a property. Things that you need to be aware of that you're responsible for the financing. If you get a loan, you're probably going to have to sign a personal guarantee. Y'all know what that means? It means if the lender forecloses, not only can they foreclose, they can also come in and take some stuff from it. All right? It's rare that a lender in California does that because they have to go through what's called a judicial foreclosure, but it's possible. Okay, just know the risk that you're dealing with. You got to come up with the down payment, and you're liable for pretty much everything that goes on at the property. All right. So I can go on and on with what you can do when you buy on your own. Right. But here's what I. All right. Here's what what I'm excited about and what we're starting to do more is co-investing with partners and co-investing with sponsors. Even Don Trump will go out and raise money. He may not have partners, but he'll use another form of money, a fund's money, and institutions' money to acquire that property. Right? It's a way of doing more than you can do individually. Right? You put your money together, so maybe you couldn't buy a skyscraper together, but a few investors together in a fund, now you can do more than you could by yourself. All right? Yeah, absolutely. And you're just using leverage to accomplish more. It's been done from the beginning of business to now. And I think I won't go into too many details because we're right at that 8:30 point. But the bottom line is, this is a way for you to go out and acquire. You can do all the same things that we talked about before, but now when you do it with people, you have an opportunity to be able to do more. Some of the pitfalls. Everything is not perfect. You're dealing with people, right? It's the technological age, but it's still real estate specifically, it's still a people business. Even if you're leasing an office building, you're leasing to a company. But there's a CEO of that company. There's an HR person. It's a people business. So when you are investing with other people, you got to make sure that the team, the people that you're in with, you can work with, because everything is not peaches and cream. Don't believe the late night seminar that's, oh, real estate, it's all good, and you're going to do one deal and you're a millionaire and it's all good. And hey, it's going to be some challenges. So therefore, whether you buy individually or with others, make sure it's people that you can lock arms with and that you can go to war with, right? You know what I mean? Go into battle with, because you're going to have some things to deal with. So the people you deal with, I would say, is the most important thing. Everything's not going to be peaches and cream. Even a good market, you got to fight for stuff. So the guys, the gals, the people you're working with, it's important. The most important thing you got to look at. But the bottom line is you can do more than you could do individually. All right? So one more slide and I'll let you go. And this is, I took a screenshot, but you can't really, that is the Oakland skyline, Lake Merritt. This is out of the National Real Estate Investors, I think it's last month. I think it is January. I think it's January's edition.
January 17th.
Right, January 17th, National Real Estate Investor. It's a magazine, it's a real good magazine for any of you investors out there, I suggest it. I had to show this to y'all because this is the top 10 multifamily markets in the country. Y'all know who number one? Oakland, California. No, can you read that, Mr. Williams?
We are sexy.
What's the name of the magazine?
That's called National Real Estate Investor.
Oakland is number one. National Real Estate.
National Real Estate Investor. Yeah, I was going to say it's investor. No, it's a National Real Estate Investor. And they have an online website. I get all this stuff online. But if you want to do print, you can do that too. But I just wanted to, and look, 7 out of the top 10 cities in California. Now, if you'd have did this 5 years ago, we wouldn't see there would have been no California cities on there. The good part of this crash is that, I know a lot of people lost properties, okay? But the silver lining out of this is that prices dropped significantly. Remember what I said in the beginning, rents didn't really drop that much. And we live in California. California, there's a lot of people in California. Something like 38, 40 million people, right? California is like a country kind of. How many people we got, how much money, the economy and everything. Well, within California, the Bay Area is the leader of economics, of real estate for sure, and a lot of other things. Within the Bay Area, well, everything's expensive. Oakland is by far the most affordable big city in the Bay Area. Also, Oakland is central.
Transportation.
Absolutely. You can get to anywhere from Oakland. But the big thing, and this article goes into, is that it says it right here. You might not be able to see it, but it says much of the demand is spillover from San Francisco.
Yeah, because their rents are way too high. They're not sustainable.
San Francisco is ridiculous.
70% renters now.
Yeah.
That can't make a city.
And it's so expensive. But at the same time, it's about 10, 15 minutes from right here. The other night, I took my wife out to this steakhouse in the city. I live in the Oakland Hills. I wanted to say, okay, well, how long on a Friday night did it take to get from Oakland? Oakland Hills off Keller. So I'm kind of deep towards San Leandro. Man, from my house to when I parked, y'all know how parking is in the city, right?
Yes.
Was 22 minutes. And this is at 7 o'clock at night,
Yeah.
right? If you're downtown or West Oakland, it's 10 minutes. If you're on the BART, it could be 5-10 minutes. How easy is it for you to live here, hop on the BART and go to work every day and come on back here versus, hey, you're working in the city at Zynga or Twitter or Foursquare or whatever, and you paying $2,500 for a studio.
This is where families are actually coming when they're young and whatever, running around. But when they make babies, they're coming here.
Because they can afford it.
Because they can be close to their families
Right.
and have a beautiful life.
And a lot of people is figuring out when they get, Oakland, it ain't as bad as I saw on TV. You know what I mean? Now, you go to certain neighborhoods,
They don't put the good stuff on TV.
right, you go to certain neighborhoods, it's tough for sure. But the bottom line is, Oakland is number one is the number one multifamily market in the country right now. Also, it's number one in, fastest time on the market or quickest time on the market for home sales. It's number one for growth appreciation. They're expecting a 9% growth in home prices here in Oakland this year. I want to show this to y'all tonight
They're
because
still relatively cheap when you compare them to
Oh.
all the surrounding
when you
areas.
look at San Jose, when you look at San Francisco, when you look at Napa area,
Look in the
the
valley.
peninsula,
Pleasanton.
it's a good place to
Pleasanton
invest.
has, see, I was raised here, but I live in the other side of the hill, and I can tell you, there's absolutely no transportation there. And all of us old people are gonna
Speak for yourself.
continue flocking here because we wanna still live,
Yeah.
get around.
And look, everything's around.
Great
So,
place to buy.
I could go into, I love Oakland, I'm born and raised here, so I love it here, but just looking at the numbers, looking at the economics, and what other people are saying, this is a great place to invest. So what I would
Honey,
suggest you
you're
guys
in.
do. And I suggest y'all to look into Oakland, invest into Oakland, do business in Oakland. So with that being said, I want to thank y'all for coming out tonight. I think this has been very productive. I learned a lot. I hope y'all learned a lot. Let's just do it. If you have questions, just stick around. 'Cause I know I want to get everybody out of here. If you guys got to go, if you got questions, just stick around. But I want to say thank you and best of success in investing. And I'm picking the Seahawks myself.
Plus, 2 1 big.